Hello students, the topic that I am going to discuss with you is net present value method. There are many methods of evaluating profitability of capital investment proposals. There are basically two methods being used for the same. One among these methods is traditional method and another one is discounted method. The topic that we are going to discuss today, that is net present value method, comes under the discounted method of capital budgeting. The traditional methods of capital budgeting, that is payback period method as well as the accounting rate of return method, suffers from the serious limitation that give equal weightage to present as well as the future flow of incomes. These methods does not take into consideration the time value of money. However, the time adjusted or the discounted cash flow methods, which are net present value method or internal rate of return method, takes into account the profitability and also the time value of money. These methods are also called as modern methods of capital budgeting. Now moving towards the net present value method. In this method, the net present value of all inflows and outflows of cash occurring during the entire life of the project is being determined separately for each year by discounting these flows by the firm's cost of capital or maybe the predetermined rate. Now let me make it more clear to you by using certain steps by which we can calculate the net present value of each of the project. Wherein the first step is that first of all we need to determine an appropriate rate of interest. This rate of interest should be selected as the minimum required rate of return, which is called as the cutoff rate or the discount rate, and this discount rate should reflect the opportunity cost of capital of the investors. So after deciding the appropriate rate of interest or the cutoff rate, we need to compute the present value of total investment outlays. But if the total investment is to be made in the initial year, then the present value shall be the same as the cost of investment. In simple words, since the investment outlay occurs in the current year, therefore there is no need to discount the total investment outlay as it will remain same. After that, we need to compute the present value of total cash inflows. Here the inflows which I am talking about is the profit before depreciation but after tax, which means that we do not use the accounting cash inflows like we have used in accounting rate of return method. After calculating the present value of inflows, we need to calculate the net present value of each project, and the net present value is calculated as present value of inflows minus present value of outflows. Now after calculating the net present value, if the net present value is positive or 0, then the proposal may be accepted. But in the case the present value of inflows is less than the present value of outflows, then the proposal should be rejected. Now the formula of net present value will look very similar to the formula which we have used in time value of money. First of all, we need to calculate the present value of outflows, and if they are occurring in the current year, they are going to remain same. But while calculating the present value of inflows, the formula will be, and each of the cash inflows is being discounted by the appropriate cutoff rate for each of the year. And after calculating the present value of outflows and the present value of inflows, we need to calculate the net present value, where according to the formula, the net present value is equals to the present value of inflows minus the present value of outflows. So if in the case the net present value is greater than or equals to 0, then we need to accept the proposal. But if the net present value is less than 0, the proposal is being rejected. Now let me make it more clear to you by using an example. Now in this example, there is a project X, and this project is assuming a discount rate of 10%. We often call it as the cutoff rate. The initial investment in the project X is rupees 20,000. which means that the investment outlay is rupees 20,000. The estimated life of the project X is 5 years and the scrap value of the project is rupees 1,000. By scrap value, what I mean is that after 5 years, the value of the project will be just 1,000. The cash inflows, that is profit before depreciation and after tax, in the first year the cash inflows was 5,000. In year second it was 10,000. In third year it was again 10,000. In fourth year the inflows were 3,000, and in the fifth year the inflows were 2,000. So we need to calculate the net present value so that we can see that whether we need to accept this proposal or we need to reject this proposal. Now looking at the steps of calculating net present value method, the first step was that we need to determine an appropriate rate of interest or the discount rate. Now in this question, the discount rate is being given to us. So according to the second step, we need to calculate the present value of outflows. Here the initial investment of the project X was 20,000, which were being made in the current year. Therefore the present value of outflows will remain same as rupees 20,000. So we don't need to discount it with the cut-off rate of 10% because the outflows are occurring in the current year. But now we need to calculate the present value of each of the inflows. We had 5 inflows, that is 5,000 for the first year, 10,000 for the second year, again 10,000 in the third year, 3,000 in the fourth year, and 2,000 in the fifth year. Now we need to discount it with the appropriate cut-off rate which is being given to us, which is 10%. So we are discounting each of the cash flows with 10% for each of the year. But one thing here to be noted is that in the fifth year itself, the scrap value of the project was 1,000, which may also be treated as the cash inflows. Therefore, we need to write down 1,000 and discount it with the appropriate cut-off rate. And since the scrap value is occurring in the fifth year, therefore we discount it with 5 years. Therefore, the present value of the inflows is 24,227. Now next step was about calculating the net present value, and which can be calculated by, now NPV can be calculated as present value of inflows minus present value of outflows. Here the present value of inflow is this. We need to subtract the present value of outflows from it, and the value was 20,000. So the net present value is 4,227. And since this value is greater than 0, therefore we need to accept this proposal. Since this method takes into consideration the time value of money, therefore this method is considered as one of the appropriate method for selection of the project. Thank you.